Ultimate wealth is found in wisdom alone.
Perfect. All right, well, I think we should kind of get this thing going because we've got a lot of great tax code to go through.
Yeah, I can't wait.
So I'm going to go ahead and start sharing my screen. Thank you, everybody, for participating. We're going to be going over Secure 2.0. So buckle up, and here we go. All right, so Secure 2.0 is what we're going to be covering today. Everybody here should know me. I'm Neil. We have Robert Wallace on the phone or on the call with us here too, and then Kem Rondeau. Robert's lead advisor here at Axiom, and Kem is our executive assistant. So, and special thanks, Kem, to you. I put that in here for helping us get this whole thing set up. So appreciate you kind of just taking it and running with getting the emails out and getting participants to join on. So there is a lot of data here. Everybody that's in this, I just want you to just be patient. It's only an hour of your life. And please ask questions, because if you don't, then Robert and I are going to be, just going on and on and on about tax code. So if you don't ask questions, it's going to be exceedingly boring. So please ask questions.
Yeah, and all of this is brand new. They just came out with the Secure Act 2.0 in December. So this is all brand new changes.
Yep.
Very exciting stuff.
So as always, everybody should know this at this point, but we are not tax professionals, so don't take this as personalized tax advice or even personal financial advice. You may come across something in here, you go, this really applies to me. And if you want to go into more depth, please reach out to us. But this is just general generally about Secure 2.0. And then the sources for this information we've listed at the end of the presentation. And so if you're interested in reading more from our sources, we're more than happy to send those over to you as well. So game changer ahead. So Robert, you tell me, is this a game changer?
In some ways, there are some game-changing aspects to 2.0, but in large part, it's refinement of the first Secure Act that Congress passed in 2019. That's where a lot of the really big stuff happened.
Yeah.
This is a refinement of that. They're fleshing out a few opportunities that make a lot of sense. There's some stuff that does move the needle for a lot of folks, but yeah, it's more of a refinement than a whole new game.
Right. Would you say net positive or net negative to our, general clientele and who we deal with? Is it a good thing for them, or was it a net negative thing to them?
My opinion is net positive. I think that there's a lot more new opportunities that this is opening up than it's taken away. Now, not everything is positive, but in large part, I am pleased with a lot of the features that they've put into 2.0.
Totally agree. Absolutely. I think this is by far a net positive. So most of everything we're going to be coming over here today and going over is a net positive to the American public. Yep. So Secure 2.0, why is it 2.0 not 1.0? Well, Robert mentioned this earlier, but the Secure stands for Setting Every Community Up for Retirement Enhancement Act. It was passed at the end of 2019. So this is kind of the upgraded version. They added some clarity, what was in Secure 1.0, and it was included in about 300 pages of the omnibus bill that was passed December 23rd of 2022. That included.
Neil, how big was that omnibus bill?
It was an ominous omnibus, $1.7 trillion Consolidated Appropriations Act. So, yeah, this is again, it's just 300 pages that were included in that. So what we're going to go over today here in relation to that is kind of a chronological order because there's some things that they interpreted for us in the past, some things were just in 2022, some things in 2023, and then every year and beyond. And in my mind, it's easiest to think about these sort of silos because they're going to be covering a lot of things today that frankly don't really apply yet. So just keep that in mind, that a lot of what we're going to go over here doesn't even apply just yet. So we're going to kind of be starting in each year and which applies to what year. Also, we're not going to cover every single aspect of the Secure 2.0, but trying to focus on things that we thought we have clients that this could apply to. We have clients that this could apply to. And so we kind of tried to break it down and pull just the nuggets that were important. And then we're going to be trying to cover some of the takeaways, actionable items, to-dos that may come up from this year and beyond. Fun fact for Secure 2.0 is that it was Representative Neil Richard that proposed this, a Democrat from Massachusetts in District Number 1. But for those that are wondering, we're of no relation. I think I would have probably added a few other things to Secure 2.0, but
I don't doubt it.
Well done. Okay, so this is big picture summary here. You can see this kind of gives a real rough expectation of what we're going to be going over here, but a summary in 2021. What would apply in 2022 and 2023, 2024, 2025, 2026, 27, and 28. And then actually all the way out to 2033, and there were some things that were actually before 2021. So
looks a little overwhelming when you look at it that way.
Hey, you know what? There's going to be a lot of small print on this. So again, please ask questions. If you read something on here or we don't explain something well enough, just say hold up and let's go into it in a little bit more depth. But let's get going. So here we go. So 2020 and 2021, there were a couple retroactive things that were more or less definition changes that were part of Secure 1.0. And so some of those things included the disaster distribution penalty exception. So this applies to those that took out money for COVID, took money out of their retirement plans. They've added some definition to that we may have one or two clients that could apply to. They also help define the tax credit for small employer and their pension plans, and whether or not they got that tax credit or they didn't for the startup credit from Secure 1.0. So there's a couple things that may apply to a couple of our clients from 2020 and 2021. 2022, so it was a pass in 2022, December 23rd. So a couple of those things include an unclaimed savings saver bond. So this requires the Treasury to share certain information related to the registration and maturing of savings bonds in different states. My interpretation of this is it may be helpful to go find a lost savings bond somewhere, but in reality, it's probably a state revenue generating function, because now the Treasury, rather than just holding that information, is going to be required to send those savings bonds to the states, so that could potentially take them as abandoned property, because abandoned property is by state, but each state has their own process to that too. So that could apply to some of our clients. Qualifying longevity annuity contracts. So we don't have many clients that this would apply to, but they're expanding the availability of that. Again, this is in 2022. They define the statute of limitations for heirs in IRAs to begin at the time that the tax return is filed. There has always been a little lack of clarity around that, but now we have clarity of when the statute of limitations begins. Early distribution exception for terminally ill individuals. It only makes sense that if you had to pull money out of a retirement account for a terminal illness, that you wouldn't be tagged with a 10% penalty. So prior to 59.5, they've eliminated the penalty for terminal illness distributions, and no penalty for corrective distributions. This is for those that contributed too much to a retirement account or too much to a Roth IRA. It eliminates the excess contribution penalty, if they get that returned in a timely manner. Again, this is all in 2022. Also in 2022, which frankly I have down here in smaller writing, that very unlikely that plan providers are going to be able to create the infrastructure to accept a Roth treatment of employer contributions, because these have to be kind of siloed inside a 401k or 403b, etc. So very unlikely that they're going to have that infrastructure created, but it did allow for the optionality to have Roth treatment of employer contributions. That will, though, come into play for 2023. So as your 401k, 403p provider has the infrastructure to accept those employer contributions as Roth, it would be great to be able to, if you're already doing Roth and you like that Roth concept, we love it. No RMD, tax-free growth, tax-free distribution to heirs. Really a lot of great options with Roth. But that was also in 2022. And then the last thing, we have basically 1 or 2 clients this could apply to. If they have a pension plan that's been overfunded, they can use part of that overfunded plan to use it for health and life insurance, but not very common. All right, Robert, my mouth is dry. Take it away.
You got it, Neil. So starting this year, one of the big changes that Secure 2.0 is bringing is kicking out the required minimum distribution age once again. In 2019, they moved it from 70 and a half to 72. Now Secure 2.0 is moving the beginning age from 72 to 73. And this year is actually an interesting exception year, because if you turn 72 anytime in 2022, then you're subject to the RMDs last year and this year and every year going forward. But if you turn 73 this year, you would have been 72 last year, you're 73 this year, you're exempt from it now. Starting January 1st of this year, the RMD beginning age will be 73, and that will, so if you turn 73 in 2024, you're going to be having your RMDs begin next year. No new RMDs this year. And then they are going to do another stage of this in 10 years. In 2033, they're going to be pushing the RMD age back to age 75 for anyone born in 1960 or after. So this is one of the big movers, in my opinion. This is going to be a bit of a needle mover. A lot of planning opportunities around this.
So let's say somebody's 73, turns 73 this year, Robert. Do they have an RMD?
Nope, not this year. They will begin taking RMDs in 2024. This is that window of that change. Turning 72 on December 31st of 2022 means they're subject to the 2022 and beyond RMDs. But turning 73 this year, that changes it.
Yeah, because you'd have to have turned 72 last year, so your RMDs would be turned on. They don't turn off though this year. So if you turn 73 this year, you still are going to have your RMD, and then you're going to have it for the year after the year after year. But if you turned 72 this year, January 1st, and then 73 next year, then technically you wouldn't have to take it until 2025, by April 1st of 2025. You have this sort of gap year. The key is this: no new RMDs that you have here. Yeah, no new RMDs for 2023. Yep.
And they have not made any changes to that that first year RMD deferral. That still exists. Like you said, Neil, that could begin as late as 2025. But the caveat on that is that you'd then be subject to 2 RMDs in that first year. So.
Sure. Yep, probably not advisable to do that, but it's possible now to kick a new RMD out until 2025.
It creates some good planning opportunities.
Yeah. One other thing that was changed is the RMD penalties. There used to be an excise tax, and it didn't matter what tax bracket you were in. If you missed your RMD, it was 50% of whatever you missed. Huge penalty for not taking your required minimum distribution on time.
Yep.
They've reduced that to 25% and even down to 10% if you take it before an IRS audit. So
voluntarily say mea culpa.
Right. Yep. So that's a big deal. But if we've done our job, hopefully we don't have any clients that haven't taken their RMD on time. Yeah.
Exactly. And then they're also making some changes to annuities where they, because of the RMD amounts and the guaranteed annuity amounts, they're changing the RMD requirements on that as well.
Yeah. Don't have many clients that would probably apply to, but could be a game changer for those that already have or are already electing or already taking distributions from existing annuity accounts. We have some of those for sure.
Yep.
All right, other changes, and this is going into 2023. So this is this year. This is a big deal. So this is the second thing Robert mentioned at the beginning of this, and he and I both agree. This is probably one of the bigger game changers for the broad swath of all of our clients, and that is being able to make a simple IRA or a SEP IRA contribution as Roth. You haven't been able to do that in the past, and so this has really pushed people to do the 401k because you've had the Roth 401k now for a number of years. But being able to do that for a small employer is a big deal. If you've earned out of being able to make an IRA contribution, you have some 1099 income on the side, et cetera. This opens up a broad swath now of new Roth IRA contributions to be able to go to SEP and simple IRAs. SEP stands for Simplified Employee Pension. And a simple IRA is a type of employer-sponsored plan that smaller employers often will execute for their company. But this is a big deal.
Yeah. So, savings incentive match plan for employees, I believe.
That's what simple means. Yeah.
Yeah.
Yep.
And this is a very big deal. Great amount of new planning opportunities that we have to work with now.
Absolutely. Yeah. If you already have a simple or a SEP, this will likely though require a new account to be created. So something to keep in mind if you think this may apply to you, whether or not the SEP or simple is with us or not, definitely will require a new account. A couple other things that are changing in 2023 for sole proprietors that are starting a solo 401k. They're allowing now you the ability to make a prior year contribution after January 1st. There used to be this hard deadline. So this allows a solo 401k more or less to operate like a SEP IRA, where you can make the prior year contribution after the next year starts. So that's a bit of a big deal for some of our sole proprietors.
It's been a hard deadline for a long time on those 401ks. Once the year changes, you don't get to make any more contributions.
Yep. Also for 2023, they've expanded out the small employer startup plan, which is a tax credit now. Up to $1,000 per employee is a tax credit. That's a pretty big deal. For any employee that makes under $100,000 a year. So that could be an enormous tax credit to help get, to secure every community's retirement. big deal to get these retirement plans to start up. So
I agree. I agree wholeheartedly.
Robert, qualified charitable distributions. You love this category. Why don't you give us a little breakdown of this?
I do. Qualified charitable distributions are a great way to reduce taxes on IRA distributions and being able to reduce the impact of those RMDs. The age for QCD eligibility is still 70 and a half. They have not changed that at all. But starting with Secure 2.0, they're now changing the limitation, the dollar amount that will be allowed. It has been a fixed $100,000 cap up until now, but starting this year, they're going to begin to index it with inflation. So in 2023, it is still $100,000. It'll begin actually indexing to inflation next year. But this is a great opportunity, and there's opening some new eligibility into some of the charitable remainder unity trusts, and I like where this one's going.
Yeah, again, this year it's going to remain at 100,000. If you're lucky enough to be able to give that kind of money to charity directly from your retirement account, next year it's going to go up a little bit more and a little more depending on where inflation's at. This last part of being able to make a potential contribution to a charitable remainder unit trust I think is also a fairly big deal. But this is a pretty sophisticated area of planning that I suspect over the years to come, they're going to create account types that are kind of like a uniform trust for minors account. It's going to be a much more easy thing to get set up. Right now, a charitable remainder unit trust would require a lot of attorney time to get set up, and it may not necessarily be worth it right now, but something to think about.
Yeah, I agree.
All right, so 2024, we just moved another year. So from now on, this doesn't apply yet. This is not till next year. Not yet, not yet. But for those still with us that we haven't bored you to death yet, this is going to apply for next year. So Robert, why don't you give us a little rundown of this 529 plan to Roth transfer?
All right. Well, this is another one of those, why didn't they think of this sooner sort of concepts? Because everybody loves to help contribute to education funds for kids and grandkids and nieces and godchildren, et cetera. But, there's always that question. What if they don't end up going to college?
Right.
What if they get scholarships and don't need this? What if they, what happens to the money if they don't spend it on those qualified education expenses? Well, now they're finally allowing an extended qualified opportunity on that, there's the opportunity to roll it into a Roth IRA down the line if the beneficiary doesn't end up spending it on college. That is another tool in the tool chest. So I really like that opportunity.
Yeah, this to me is probably the biggest for all of our young families. This is a big change. There's always this question, UTMA, Uniform Trust for Minors, or 529 plan. This just makes that 529 plan that much more attractive. I'm calling it a 529 plan to Roth recharacterization of contribution as contribution, because it does eat into that person's annual maximum contribution for the year up to certain maximums. At least that's how we understand it right now.
That's true, and that does. And if it's a young person who's freshly not out of college or with scholarships, the opportunities are big for being able to make that conversion.
Right. I was talking with somebody about this, a friend of mine recently, and I did say, you know, the 529 plan does have to get listed on the FAFSA. And so oftentimes that 529 plan will be used because it's pretty broad definition now for books, tuition, housing, other things. You can use it for a lot more things now related to education. So it's likely
And K
they
through
will
12.
use it. Right. And K through 12, right. So this is in that scenario where somebody gets a full ride scholarship and doesn't use their 529 plan at all. Well, now you can start putting that into their Roth IRA. So next up here, this is again in 2024. So Roth plan distributions. If you had a Roth 401k or Roth TSP, Roth 403b, they're eliminating RMDs on those employer plans as well. It used to be you had to roll to an IRA in order to maintain your RMD-free Roth contribution. And so it was a no-brainer to roll that over, but they're eliminating that and expanding it out to include Roth 401k, Roth 403b.
And really is a common sense update. Now, there's no reason for RMDs to exist on Roth accounts anyway, because the taxes are already paid. So it's just, it's a common sense update.
Speaking of common sense updates, to me, this one may be one of the negatives of the Secure 2.0 in some ways.
Yeah.
If somebody's trying to make a catch-up provision, so this is for those that are making elective deferrals to defined contribution plans and making a catch-up contribution, they're requiring now, if you make over 145,000, that contribution be made as a Roth contribution or an after-tax contribution. And the reason I think that's a negative is because if you have to make a catch-up contribution, shoot, you're trying to catch up, you should probably get the deduction. You're in the higher income bracket anyway.
Or at least have the opportunity to make that decision for yourself.
Right, right. Yeah, so this coming into play in 2024 for those that are a little older, making over 145,000, that contribution is going to be required, that catch-up contribution will be required to be Roth.
So again, the base contribution, currently that 22,500 contribution, that can still be traditional or Roth contributions, but the catch-up on top of that, the additional catch-up contribution over age 50, that is where they're restricting the opportunities to only Roth for the higher earners.
Correct. Early withdrawal penalty exceptions. There's a number of these for emergencies, which I believe now is $1,000 per year per emergency. You can pull money out without the 10% pre-59.5 penalty. Also for domestic abuse, they're allowing withdrawals prior to 59.5 without the 10% penalty. Simple IRA non-elective contributions. Limits are going up. So simple IRA in the past has limited non-elective contributions to 2%, and that's going up to 10%.
I'm going to take a pause for just a moment. We've covered an awful lot of ground. I don't see any questions yet. If anybody does have questions on anything that we've covered, please go ahead and hit the Q&A button down at the bottom and put your questions in for us. We'll be happy to go into better depth.
And I'm keeping a watch on that, so please don't hesitate to send a message or even an email if you don't want to do that later on.
All right, we'll charge forward with more small print here. So
carry on.
Yeah, so we're still in 2024, which is when a lot of these major changes come into play. IRA catch-up provision will index. That's a big deal. So note that if you're catching up on IRA contributions, we'll need, if we're doing a monthly especially, we're going to need to change that each year to keep pace with, this is on the catch-up provision, not just the maximum annual, but the catch-up hasn't changed. It's been $1,000 for many, many, many years. And now they're going to put an index on the catch-up contribution as well.
That'll be a great addition.
Yeah, mandatory distribution limit raises. So this is probably a bone to the employers that have a bunch of small accounts. It used to be 5,000. They could kind of move you out of the plan. They've increased that to 7,000. Transfer of eligibility for 72T accounts. 72T is a IRA provision that is related to substantially equal payment. So you can retire before 59 and a half as long as you take a 72T qualifying payment. In the past, once you did that, it locked in your IRA to wherever it was at. And now they're going to allow you to take that account with the 72T payment and move it to a different location. So you're not locked into that account for the rest of your life. So that's a nice thing.
It doesn't apply to an awful lot of people, but it is a great planning opportunity for those who it does apply to.
Correct. Surviving spouse election to be treated as employee. We have a couple of clients that this could apply to. So what does that mean? It means that you can be treated as the deceased employee. If you're a spouse, you can be treated as your deceased spouse as it applies to the employer-sponsored plan. So I wrote down here, this applies to surviving spouses that are older. Maybe they're in RMD age, but they have a younger spouse. They can claim to be that younger spouse's age for RMD purposes. So this is kind of a big deal if you have a large age gap and the younger spouse passes, to not have to take a larger and larger RMD on your own age. Yep. Student loan matching. So this allows the employer to match contributions to student loan payments. I would see this applying probably mostly to like our self-employed folks that are going to match their own student loan payment, but it does allow larger employers to match student loan payments. And then this is one that I've been kind of advocating for and wishing they had for many years.
This could apply to a lot of clients.
Yeah, for sure. So this allows an employer to transfer to a 401k mid-year. It used to be you knew you needed a 401k in January, but you already made one contribution to your simple. You had to wait to the next year. So this allows simple IRAs to be transferred to 401k plan mid-year. So my opinion, this is a good thing.
We're not done yet.
There's more. Okay, 2025. So I believe we just changed a year. So now we're not in 2024. Next year we're in 2025. So Robert, why don't you give us a little rundown on this additional catch-up contribution?
This is another great little new addition that they've added in Secure 2.0, and I'm considering it Catch-up 2.0. They're now making it easier for older employees who are getting closer to the retirement age and potentially in the higher income earning years of their career to be able to sock away a little bit extra into their 401k plans or other retirement plans. So they still have the base contribution limit. You still have the 50 plus catch up, but now in a few years, they're going to be bringing in the a second catch up for those employees that are over age 60 to be able to put in an additional up to $10,000 of income into their plan. It's a good opportunity for really putting in the additional savings in that last stretch of the career.
Yep, and this amount will also index for inflation.
Yep.
So.
Okay, Neil's got a little technical glitch, but we're also in 25, they're going to be bringing in auto enrollment into a lot more of the employee retirement plans. That's going to be, I think it's going to start at a default of 10% of employee earnings that will be auto enrollment. It's a negative consent, so they're enrolled unless they choose not to or to change their contributions.
Yep. Can you hear me okay, guys?
You're there.
All right, great. Yeah, and my understanding too is it's going to go up by 1% per year up to 15%. Now, that doesn't mean every employer or employee has to accept that 15%, but we are a big fan of 15% savings rate. And my my opinion is that this is going to help a lot of people that set it and forget it save a lot more of their income just through some automated enrollment strategies.
And we're big fans of paying yourself first. So this that is a great way of helping a lot of people be able to save without thinking about it.
In addition to that, you know, they're going to broaden out those that are going to qualify for a 401k or for an employer sponsored plan. So it used to be 1,000 hours. You could eliminate people if they worked less than 1,000 hours a year, but they're including that now to go down to $500 an hour. So small change, but if you're an employer that's sponsoring a 401k plan, you may have to include more people in your plan. So honestly, it's a good thing. You know, tends to help with retention, etc. Okay, we are now in year 2026. So there's still some more.
The calendar is just flipping by now.
Yeah, we're almost done. Thanks for bearing with us. Please ask questions as they come in. So 2026, there's a couple things that are changing, you know, and at the beginning of this, asking, you know, is this a net positive or was it a net negative? There's things that don't come into play yet till 2026 that I wish started earlier. And this is one of them, which is the expansion of disability to be able to start an ABLE account, which is kind of like a special needs trust account. But you had to be 26, have become disabled 26 or earlier. I don't understand that. I wish it was later. And so they pushed that back now from 26 to 46, starting in 2026. So not now, but not until 2026. But to be able to make a contribution to an ABLE account is a great thing. I wish this started earlier, but this doesn't start until 2026.
And this it does make a lot of sense and is going to be a great addition to I think that's very important for those that qualify for the ABLE accounts.
And we do have a question. We have a question from one of the viewers. For clarification, if one turns 73 in 2023, do they have an RMD in 2023?
Yes.
Most likely,
Yes.
yes, because they would have been 72 in 2022. So they would have been subject to RMDs last year, which means that this would be their second RMD year. If they're turning, you know, if they were turning 72 this year, they would be exempt until they turn 73 next year. Hopefully that clarifies things well enough.
Yeah, the easiest way for me to think about this is that if you haven't had to take an RMD yet, there's no new RMDs. But if you had to take one in the past, you got to take one again this year. So if you had to take one in last year, and so, you know, for your turning age 72, and you turn age 73 this year, you got to take it for this year.
Yep.
Yep. So yes, there's still more and some more small print. So here we are, we're out in 2027. So this is a number of years out, but there are some things that I think are important for people to know about Secure 2.0. One of the things is this savers credit. So this is going to be a federal additional contribution to lower earners to their retirement plan to really encourage them to participate. So this would be a 50% match. So if they contributed $100, the federal government's going to contribute $50 of that 100, up to $2,000 in an IRA for that person. You can see I have highlighted here. So for married filing jointly, if they're making under $71,000 a year, then this is when this type of savers credit would apply, or $41,000 as an individual filer. So kind of a big deal. Again, this is for employers out there. This is not additional money you have to contribute. This is something the federal government is going to do automatically into an IRA.
Just a quick clarification on that. The phase out begins for married filing jointly. The phase out begins at 41,000 and would be terminated at 71,000.
That's right.
Single would be 20,500. But yeah, it's going to be a good bonus for lower income families and individuals.
Yep. Disability pension payments for first responders. And I can think of a couple clients that we have actually that are taking disability that were first responders.
Yep.
And so their pension, for taking money prior to retirement age, those disability pension payments will be tax free. Again, I wish that started earlier, but it doesn't start till 2027. This last thing here relates to employer stock option plans. And so there's some tax consequences if a C Corp buys an S Corp for those that had an employer stock option plan. And so they're trying to clean that up a little bit. And then they're trying to make employer stock option plans a little bit more palatable for companies that are not publicly traded. Again, not until 2027. All right, Robert, I gotta say, I think you did a great job, and I think we did a great job on staying on time.
Likewise, Neil.
So hopefully we can get a few questions to come into the queue. But while we're doing that, let me ask you this question. What would you say is the one or two things here that really move the planning needle for our clients?
I don't like limitations like that. I'm gonna throw out my three favorite features here.
Give me three.
I think that the three pieces of this that are going to move the needle the most for the most people are, one, the bump out of the new RMD age to 73 at this point, and then 75 in another 10 years. That's going to be a big planning deal. A lot more opportunities to plan and to defer that income. Secondly, I like the new Roth opportunities and features. That's going to be a big one that has a lot of planning opportunities. And number three, I really like the opportunities presented by the Catch-Up 2.0. And of course, it's matching mustard. Yeah. That credit goes to you, Neil. That one's yours. That's your dad joke.
Yeah, the catch-up contributions for sure. Yep. The secondaries catch-up contribution, 60 plus. I like that. Yep. The matching mustard. Yeah. Roth. The only thing I think is a little, maybe bit of a negative is like requiring, if you make over the 145, requiring that to be Roth. I know we have some clients that just happen to hit a big, tax year through selling a home. Their AGI is really high. They could really use a tax deduction there in that year, but now they're kind of forced to do Roth. I guess there could be worse things, but
I think that it's actually, I think the capital gains are going to be outside of that equation. I think that it's wages only that are being included on that. So it might be more reliable and more consistent,
Okay, yeah,
potentially.
yeah. Well, I think those for me too would be the major needle movers: RMDs, the Roth contributions, the Roth catch-up, and just regular catch-up contributions. I think for people that are younger, you know, kicking out your RMD age to 75, you know, that's all. I mean, everything here could have significant meaning to your planning, but I think the ability to make they call it the Rothification of retirement plans, I generally really like. I've said for many years that the Roth has been one of the greatest gifts to retirement planning generally, and for estate planning. So it's actually really great. It's kind of like the government making a little bit of a short-term decision rather than a long-term decision for taxes. So I like that for our clients.
Like like we were talking about earlier, I think that it's, we're talking about the ones that are going to affect the most people and have the biggest impact, but only one item needs to be that meaningful piece for an individual client. That one nuanced change could be the needle mover for that individual.
Yep. The other thing, I know I brought this up in our last webinar, and let me know, Kim, if we have any questions coming in the queue.
I'll do that.
But I've said this 529 plan to Roth rollover, to me, for our everyday conversation with folks, grandparents making a contribution, saving for education. It only makes the 529 plan that much more attractive as an option for saving. So again, being able to move that over to a Roth could be a real big planning benefit that would move me to say, hey, let's do a 529 plan over the UTMA. Yeah.
Yeah, I agree.
Well,
No questions.
no questions.
No
Well,
questions.
as always, for anybody that's here, if there are questions, if there's something that we went over briefly, I'd like to go into more depth on, never hesitate reaching out to us. We like to geek out on these planning opportunities, and there are a lot of them. So never hesitate reaching out to us, Robert or myself, or to Kim, to get something scheduled to go over it in more detail. But with that, unless we don't have any other questions, we'll say good night to everybody, and thank you for participating.
Good night.
Good night.